Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. So what if I told you I was going to run a marathon? In fact, every time I see you, I talk about running this marathon. I show you my running shoes and show you my running magazines. I explain my training program to you. I buy running shorts and start wearing running t-shirts. And yet, I never actually run. Would you believe I'm really going to run a marathon? Well, of course not, right? In the immortal words of Toby Keith, you would need a little less talk and a lot more action before you would have any faith in my marathon ambitions, right? I listen to a podcast regularly called Sports Day Tampa Bay, and the host is fond of saying, if you have audio and video, believe the video. In other words, believe the actions that you see over the words people are telling you. Since Kevin Warsh stepped into his new role as chairman of the Federal Reserve, he's been talking tough, insisting the central bank will not tolerate price inflation running hotter than the mythical 2% target. And he doubled down on that messaging after the July FOMC meeting last week, saying, quote, "You've heard this before, but we will deliver price stability." But what has the Fed actually done to deliver price stability? Nothing. And the markets are already starting to lose faith in the Warsh-led central bank's willingness to tackle the inflation problem. So that's what we're going to talk about today. We're going to go over the FOMC meeting last week and talk a little bit about what exactly is going on with the Federal Reserve and what it might mean for the precious metals markets. But before we do dig into all of that, I do want to thank you so much for listening to the show. And every week I say this, every week I mean it. I know that there are so many things out there vying for your attention, and I appreciate the fact that you spend a little bit of time each week listening to this show. I would really appreciate it if you would help the show to grow. If you find value in it, I'm sure other people will as well. So if you could go to wherever you listen to the podcast, whatever your podcasting platform of preference is, and write us a little review. Give us those stars, the thumbs up. And also, if you would be so kind, is to share these episodes on your own social media platforms. That will help grow the show, expose it to more people, and help more people learn about sound money. So yeah, if you would do that, it would be very, very helpful. And I would say thank you again. But most importantly, just again, thank you so much for listening to the show. So last week, the FOMC held its second meeting of the Warsh era, and Warsh kept calling it a family fight. He likes this term, family fight. He's used that phrase a number of times in his speeches and news conferences over the last few weeks. And I guess the family did fight, but it really amounted to a lot of yelling and no actual punches thrown. So I guess that's good. We don't have to call the popo. But in what was anything but a foregone conclusion, the Fed did end up holding the federal funds rate steady at between 3.5 and 3.75%. However, the decision was not unanimous. And again, Warsh described it as, quote, a good family fight. And we had 3 committee members split from that 9-person majority to push for a quarter-point rate hike. So there is starting to be a little bit of sentiment toward tighter monetary policy among the members of the Federal Open Market Committee. So, in summary, the Federal Reserve is talking a lot about fighting inflation, but it's not doing a lot to fight inflation. And by not doing a lot, I mean it's not really doing anything. It's pretty clear that Kevin Warsh is trying to put his stamp on the Federal Reserve. And he's made it clear that he is not Jay Powell, and the new sheriff in town is going to run things much differently than the old sheriff. That's definitely the impression Warsh is trying to create. It's a new day for the Fed. We're doing new things. I'm a new person in charge, so things are going to be a little different around here. And, one thing's for sure. Warsh is very different than Powell in the fact that he isn't really big on letting you know what's next. And he has said that he will provide much less quote unquote forward guidance than Jerome Powell did. So in other words, he doesn't really want the central bank to signal its intentions. And this was really a trademark of the Jerome Powell chairmanship. He loved to signal. He loved to run what I like to call open mouth operations, where he would talk and the markets would move. And by the time we actually got to any policy decision, it pretty much was a foregone conclusion. Everybody knew what Powell was going to do. I really can't think of very many meetings during the Powell era where we went in literally or legitimately thinking, what are they going to do, right? We always knew, they're not going to hike, or they are going to hike, or they're going to cut. It was signaled well ahead. Warsh says he's not doing that, and so far he has stuck to that commitment. There was genuine uncertainty in the markets as to what the Fed would do at the July meeting. And before the meeting kicked off, I even saw some analysts forecasting a rate hike. Like, there were those out there that thought, yep, this time the Fed is going to do it. They're going to hike rates. Most people were still pretty sure they wouldn't, but there was a lot of uncertainty. Now, you know what markets don't like very much? A lot of uncertainty, right? Surprises cause sharp swings in markets, and investors don't like sharp swings in markets. Here's the thing, though. Even if you don't provide clear forward guidance, the markets are going to concoct some, right? Markets are forward thinking. They're forward looking. That's what markets are for. We're trying to anticipate, what is this asset going to be worth? What is it going to be valued at a year from now, 5 years from now, 10 years from now? That's what the markets are thinking. So if it's not clear what's going to happen, they're going to make something up and run with it. They have to do something, right? Now, when there's a lot of uncertainty, you will see a lot more volatility in the markets. And that's certainly been the case over the last, really 2 years, but certainly for the bulk of this year with the Iran-U.S. fighting a war. Every time there's some news on the war, the markets respond. So there's been a lot of volatility, but they are trying to figure out what's going to happen next, right? There's a lot more danger of markets getting stuff wrong and then having to readjust down the road. For instance, if the markets think the Fed is going to hike rates and it prices things in the future with that in mind, the markets are going to quickly adjust. You're going to see an even sharper swing if the Fed doesn't follow through on that expectation. Now, on the other hand, I reckon less forward guidance allows more flexibility on the part of the Federal Reserve, right? It's less likely to make a bad move just because the markets are anticipating it. It's not being locked into, the stock market thinks we're going to do X, so we got to do X. So I can understand why Warsh kind of wants to approach things this way. And let's be honest, even though Powell liked to give forward guidance and he did it well, he even hedged a lot, right? If you actually listen to the words that came out of Jerome Powell's mouth, so often you could kind of interpret it, well, we're probably going to do this, but we could do this. He always left himself an out, which is, I guess, the mark of any good politician. And make no mistake, these Federal Reserve chairmen, these Federal Reserve members, they're not just these detached, academic, only worried about the economics. No, they're politicians. That's exactly what they are. They got into this position because they're politicians. They operate in this position as politicians. They are politicians. Never, ever forget that important reality. So anyway, we got into this meeting with some genuine uncertainty for the first time in ages. And as I've mentioned, there was some debate even among the Fed members. And we had Cleveland Fed President Beth Hammack, Minneapolis Fed President Neil Kashkari, and Dallas Fed head Lori Logan, who all voted for a quarter-point rate hike at this meeting. And then, of course, the other 9 members voted to hold rates steady. I asked for a good family fight and I got one, Warsh said in his post-meeting press conference. I told you he really likes this whole family fight thing. That's how he wants you to perceive the Fed, that they're a family and they love each other, but by golly, they're going to fight and they're going to hammer this policy out. Warsh went on, he said, most of our discussion was on the big questions that matter to the conduct of monetary policy. We didn't sort of hide from them. We weren't scared of them. There was a lot more interaction between and among my colleagues. It was a real family fight. So he's trying to create this impression, that they're doing something now, buddy. When Powell was in town, everybody was, I don't know, maybe under Powell it was like my family. My family was very passive aggressive. We very rarely fought face to face. We always fought subtly and behind the scenes. Maybe that's what was going on. But, I guess Warsh wants you to know that this Fed, it's a big Italian family. I probably shouldn't stereotype families, but I've been around some Italian families, and they can fight in a loving way. There's no doubt about that. Anyway, that's kind of that's where Warsh is going with this. So we got the official FOMC statement, as we do every month or at every meeting, and it did very little to signal how the Fed plans to move forward. It's interesting because the first statement issued by the Warsh-led committee dropped from more than 300 words under Powell to just 130. So again, Warsh ain't talking much, right? Not a lot of forward guidance there. And at the time, Warsh said forward guidance was, quote, not well suited for the current policy conjuncture. Quote, it's a bit shorter, a bit simpler, and it dispenses with some older language, Warsh said of that first statement. He said that statement just gives you the facts as best as we can judge it. So that's kind of where the Fed is going and how Warsh is trying to position the central bank. Other than information about the vote, the July FOMC statement was identical to June's. Warsh said, as before, the policy statement conveys just the facts. It's steering clear of forecasting, a choice we consider especially prudent at these uncertain times, Warsh said. Uncertainty, however, does not mean a lack of clarity. I don't even know what that's supposed to mean. We're uncertain, but we're clear. I guess we're clearly uncertain. Whatever. So this new lack of transparency has already frustrated some Fed observers. Capital economics analysts criticized Warsh's, quote, vague responses, saying they, quote, make forecasting the Fed's next move even trickier than it already was. And Warsh doesn't seem to care. He said, quote, I understand the desire for rolling forecasts and commentary from this committee, but for our part, we need to observe market reaction to developments direct and unfiltered. I want to stress, of course, that decisions by this committee matter a great deal, and where necessary and appropriate, we will not hesitate to act. Well, I guess it hasn't been appropriate yet because the Fed has not acted, not one iota. But while the Fed didn't deliver any policy changes, Warsh continued to insist the Federal Reserve is committed to returning inflation to that, well-known and much talked about 2% target. He said, quote, you've heard this before, but we will deliver price stability. And he emphasized that it will not be an easy fix. He said, we have no magic wand. This isn't something we're going to be able to carry out in days or weeks. And then Warsh bristled at calling the Fed's decision to hold rates steady as a pause. A questioner during the press conference called it a rate hike pause or a rate cut pause. And he said, quote, I would characterize what we did as a review of the big, hard questions, and I'd characterize it as a view of what our own homework is to try to resolve those questions in the period ahead. Again, a lot of word salad with not a whole lot of real meaning. But he went on to say that this is just, quote, the beginning of the story, not the end. Quote, we have begun a new chapter, and we understand that 5+ years of inflation above target cannot be cured in 9 weeks or by a single month of modest price decreases. This Fed will not waver. Our credibility rests on performing our duties and delivering on our responsibilities. Man, that sounds great. This Fed has got things under control. Warsh comes off as a regular Paul Volcker. But do you know what Paul Volcker did? He ran rates to 20% in 1980 to slay price inflation. Compare that to Warsh, who has not raised rates at all. So if you're a regular listener to the show, you know that I have been skeptical of Warsh from the beginning, at least skeptical of this tough talk, we're going to slay inflation no matter what, this notion that he is this inflation hawk. I've talked about the fact and the reasons why I don't think that Warsh will be able to be nearly as aggressive on inflation as he wants to. And now the markets don't seem to believe Warsh's tough talk either. So it's not just me. Movement in Treasury yields indicates that investors don't believe the central bank will follow through on this hawkish rhetoric for whatever reason. And it's notable that after the Fed announced its decision to stand pat on rates last week, yields on the long end of the curve actually spiked. They went up. The rate on the 10-year Treasury rose 5 basis points to 4.657%. Meanwhile, the 30-year Treasury bond yield surged by 9 basis points to 5.193%. And this indicates that the markets believe the Fed is finished hiking rates. As a CNBC report put it, quote, "We think you're going to keep short-term policy rates in check, and it's going to create a ton of inflation later." That's what I've been saying. They cannot raise interest rates in this environment. And now the markets are starting to say, you know what? It looks like the Fed is not going to raise interest rates in this environment. Reuters explained it this way, quote, "In this case, the twist that materialized around July 31st carried a clear message. Short-term yields, which are more sensitive to imminent Fed policy, stayed relatively anchored. Meanwhile, long-term yields pushed higher, reflecting expectations about sustained economic growth and persistent inflation rather than fears of additional rate hikes." So several mainstream analysts have chimed in to argue that the Fed's inflation war is nothing more than a war of words. Citigroup global chief economist and former Fed employee Nathan Sheets said that the markets appear to be voting no confidence in the Fed's ability to control price inflation. He said, quote, "Warsh highlighted a problem and gave no strategy for solving it other than, 'I'm a hawk, trust me.' And the markets wanted more than that. I think part of it is if you lean too far into future hikes, then he's disappointing the White House. And it is a balancing act between Warsh the hawk, which he is, and trying to stay on sides relative to 1600 Pennsylvania Avenue." And, you know, Sheets makes a good point. Beyond just the practical implications of raising interest rates when you have so much debt in the economy, there's also this problem that he was appointed by Trump, and Trump wants lower interest rates. Trump has made it very clear he wants lower interest rates. And remember what I said, these people are all political, right? Warsh isn't this independent technocrat who's just going to do what the economics tell him to do. He's going to try to sell that. But this idea that the Fed is this independent institution is a bunch of BS. It's not. It's a political entity with a bunch of politicians. So don't be surprised when Warsh, a politician, does politician things. And, you know, I should also note, it's not just that the Fed hasn't done anything. It's actually doing things that are in direct contradiction to this notion of we're a hawkish Fed. You know, the balance sheet is increasing right now. The Federal Reserve is running quantitative easing, right? It is buying bonds. It is using money created out of thin air to buy those bonds. It's adding those bonds to its balance sheet. We see this balance sheet expansion, and it is injecting this newly created money into the economy. Now, why is it doing this? Well, it tells you that, this is just to stabilize the financial system. It's really just a tweaking of the system. Well, that may be, but I believe the real reason is we have a situation where demand for U.S. debt is falling, and the United States is still spending billions of dollars, over $500 billion every single month. It's borrowing out the wazoo, and somebody needs to buy all of these bonds. So the Fed is putting its big fat thumb on the bond market, and it is creating artificial demand for bonds. It's holding interest rates in the Treasury market slightly lower than they otherwise would be. That lowers the borrowing cost for the federal government. That's a good thing for the politicians. Again, Warsh is a politician. So while they're talking about, yes, we're going to slay inflation, they're not doing anything to slay inflation in terms of interest rates, and they're actually working against themselves when it comes to the balance sheet. So very important to remember that. Again, watch the video, right? On top of all of that, Warsh has hinted that the central bank may try to move the goalposts when it comes to calculating price inflation. Historically, the goal has been a core PCE reading of 2%. The PCE reading is another inflation measure different than the CPI. I'll get into that here in just a second, but that's the measure that the Fed likes to use. And during his confirmation hearing, Warsh indicated that he preferred, quote, trimmed averages in determining that core PCE. As Reuters explained, in theory, this approach, quote, trims off the fastest rising prices and the fastest falling prices, leaving a more representative middle set of price changes that typically serve as a good indicator of where inflation is heading. In other words, it's just another way to manipulate the formula so that it can understate the reality of price increases. That's what this is. But during his post-meeting press conference last week, Warsh again hinted that the central bank could set a new standard for that inflation target. Now, initially, he insisted that the PCE is, quote, our number and we're sticking with it. But then he added, who knows? Come after next January, what we might say about strategy. I suspect the task forces might have something to add. And he's alluding to the fact that he has formed several task forces to evaluate the mechanizations of the central bank. And his statement seemed to hint that the task force may well still move those goalposts. In other words, they're going to try to change the standard, right? If we can't get to 2%, well, we'll just make it easier to get there, right? We'll change the formula instead of actually doing the things necessary to get it legitimately down to 2%. Reuters summed it up this way, reporting that, quote, the combination of Warsh's repeated assertions of the need to tame inflation with no action to move it toward the 2% target and a hint that the goalposts themselves may change was behind the recent jump in yields on the long end of the curve. So, what does all of this mean for gold and silver, right? Precious metals have traded sideways over the last few months because the markets believed the Fed would hold rates higher for longer, perhaps raise interest rates to take on persistent price inflation. This worry about rate hikes, and nobody wants rate hikes, mind you, right? I mean, we admit that we might need them for inflation, but nobody wants them. Everybody knows that this economy does not want rate hikes. Everybody knows that this economy is addicted to easy money. Now, they're not going to tell you that it's addicted to easy money, but that's the reality. It is addicted to artificially low interest rates. It is addicted to money creation. It needs that. It thrives on that. And if the Fed is taking that away, that's a problem for the economy. Everybody knows it. Nobody wants rate hikes. They all want rate cuts. They're just begging and pleading to the lords of the markets to give us the opportunity to cut rates, right? So that's where we are. Gold and silver has traded sideways because of this worry. We've had this spike in oil prices. This has driven the CPI higher. So there's all of this inflation worry out there, and that has really created significant headwinds for the gold and silver market. Now, we have held steady at $4,000 an ounce. That seems to be the support. Over the last few weeks, we've been bouncing back and forth between 4,000, kind of at the bottom. And today we actually got up to 4,200 because there's some optimism about the Strait of Hormuz being reopened for the 57th time. And there was also some pretty negative employment data, which has, that always spooks people that the economy is going to turn over. And it is. The economy is going to turn over. I've said this over and over again. We're due for a recession. We have not reckoned with the monetary mechanizations, the monetary malfeasance of the pandemic era, nor have we really dealt with the monetary malfeasance of the Great Recession. So all of those maladjustments and malinvestments and distortions in the economy, they're still there. They have to be cleansed out, and they will be. But what happens if the markets have really lost faith in the Fed's inflation-fighting credentials? What could this mean for gold and silver? Well, we're kind of seeing it in the markets, right? This twist in the yield curve has implications for where the markets see things going. And if they really believe that the Fed is not going to keep fighting inflation, eventually this could be bullish for gold. And of course, this twist in yield curve also has implications for the dollar, right? It signals the possibility of a weaker dollar. And you add to that the Treasury Department's apparent willingness to buy yen to strengthen the Japanese currency, and we could see a persistently weakening dollar. Now, it's really interesting the way the U.S. has intervened in the currency markets. They are trying to prop up the yen by buying yen, but apparently they're not buying them with dollars. They're buying with euros. So they're simultaneously debasing the euro in comparison with the yen and maintaining dollar strength. Very interesting mechanizations in the currency market, something you probably should keep up with. But ultimately, this is bullish for gold and silver, right? While higher interest rates on the long end of the curve could be considered bearish, given that gold and silver are non-yielding assets, higher inflation is actually bullish because the metals are historically an inflation hedge. Never forget that, right? And it's always weird to me because we've had these inflation worries and we've seen people selling their inflation hedge. And I think sometimes people forget that, right? They get so caught up in the yield side of it that they forget that they have to deal with the inflation side, the devaluation of their dollar, and that gold is that inflation hedge. I will link to an article in the show notes page that kind of gives an overview of how gold has done over the last decades in terms of hedging for inflation. And it's also very important to consider real interest rates, not just the nominal yields that are quoted on television. I've talked about this before, but I definitely want to touch on it because it's very important as you're looking at the gold market, right? Again, higher interest rates are considered to be a headwind for gold because you don't get a yield when you own gold, right? So what do we mean by real interest rates? Well, it's simply the stated rate you see on the news adjusted for price inflation. So if you want to calculate the real interest rate, you take the quoted interest rate and then you subtract the CPI. It's as simple as that. So the federal funds rate is currently set at 3.5%. You factor in that the CPI is 3.5%. The real interest rate right now is only 0%. It's 3.5 minus 3.5, that's zero. So the real rate is zero. If you have gold, you're getting no yield. If you have a, something yielding 3.5%, you still have no yield because inflation is eating it all up. Note that in a low interest rate environment, or if price inflation gets particularly high, real interest rates can easily go negative, right? Let's say that the CPI bumps up to 3.6%. The real interest rate would be 0.1%. And, we've had long periods over the last couple of decades where real interest rates have been negative, which goes back to the point that I made earlier. This economy is addicted to easy money. It's an expectation that we should have real interest rates near zero. It's great for lending, not so great for maintaining your purchasing power over time, for saving, which is why you need to save in real money, gold and silver. So when you factor in real rates, it's easy to see higher yields aren't necessarily bearish for gold and silver. It may feel like you're earning a good yield, but your gains are eaten up by inflation. So even if yields on the long end of the curve continue to rise, and they likely will, if we are in fact in the early stages of a secular bear market in bonds, I think we are. I talked about it either last week or the week before. I think real yields are going to remain relatively steady and perhaps even start to fall as inflation continues to run hot. And of course, if the economy turns over and the markets collapse, the Fed will almost certainly rush to cut rates and ramp up quantitative easing, right? Money Metals CEO Stephen Gleason actually explained how interest rates and price inflation interact in the real world. It's not as simple as rising interest rates are bad for gold. I'll link to that article on the show notes page as well. He has a real nice chart that shows how gold has performed in various interest rate environments. So check that out. But summing it all up, Warsh will undoubtedly continue to talk tough on inflation. But remember, watch the video, right? And it appears that's exactly what markets are doing, right? We've seen gold creeping higher this week. That's not to say we won't correct again if some kind of bad war news comes out tomorrow. However, I think the solid support we've seen at $4,000 an ounce indicates the fundamentals are still favorable for gold. So you might want to take advantage of these modestly lower prices. And check out some of our specials over at moneymetals.com. And right now, I'll just highlight one special that we've got going on. You can save big on my favorite gold coin, and that is the South African Krugerrand. They're only $59 over spot price right now, and there's no order minimum. I don't think you're going to find a lower spot price on gold Krugerrands anywhere. They're beautiful gold coins, well known all around the world, recognized around the world, and they were my grandfather's favorite, which is why they're my favorite. But that's a fantastic deal. There's some other ones. There's some good deals on silver as well. Go to moneymetals.com, click on the specials tab on the top of the page, and you can check all of that out. Before I go, I do want to call your attention to a little bit of inflation news, and I've already mentioned it, that the Fed may end up trying to move the goalposts on its inflation target. In other words, they want to make inflation look not quite so bad. And, they already do this. The Fed's favorite inflation number isn't the CPI. We talk about CPI all the time. It's one of the biggest reports that comes out every single month. But for the Fed, the big metric is the Personal Consumption Expenditure Index, or PCE. And this metric is actually part of the GDP calculation. And I wrote an article yesterday on the difference between the PCE and the CPI and how they're calculated and why the Fed likes the PCE better. I'm going to link to that article on the show notes page, and you can check it out and dig into the juicy details. But the short version is that the two price inflation measures rely on significantly different methodological approaches, and central bankers prefer the PCE because, quite frankly, it understates price inflation more than the CPI. Now, keep in mind, neither of these metrics measures inflation as historically defined by economists, right? Inflation is a rise in the supply of money and credit. One of the symptoms of inflation, this monetary inflation that we used to just call inflation, one of the symptoms is rising prices, rising consumer prices, which is measured by the CPI. CPI and the PCE measure price inflation, again, a symptom of monetary inflation. If you want the real inflation story, go look at the money supply. Right? Go look at M2. It is currently increasing, which is by definition inflation. And when the money supply is increasing, if it's increasing rapidly enough, we can begin to see that creep into the price structure and raise the entire price level. There is only one thing that raises the entire price level, that raises all the prices across the board. Oil shocks don't do that. Oil shocks raise a lot of prices, but they don't raise all of them. The only thing that raises the entire price level is monetary inflation, money creation. And here's the thing, I say it every week, but I can't emphasize this enough. Inflation is the plan, and part of that plan is making you think it's not as bad as it really is. The government needs constant money printing to facilitate the borrowing and spending. Right? I talked about QE, how they buy bonds on the open market in order to suppress the government's borrowing costs. That's part of it, but it's inflationary. And then sometimes they just outright print money, right? During the pandemic, virtually all of the stimulus was ultimately monetized by the federal government. In other words, it was by the Federal Reserve. In other words, it was turned into dollars and injected into the economy, nearly $5 trillion. Big government grows on inflation. Even if Warsh gets inflation under control, quote unquote, that means your money is being devalued 2% per year. That's the target, right? That's more than 10% every 5 years because remember, interest compounds. That's more than 20% every 10 years. That's the plan. They want to steal that much of your purchasing power because that's what they've determined is acceptable to you. 3% not acceptable, but you'll pick up on a little 2%. No biggie, right? But yeah, that's the plan. And the reality will always be worse than they're telling you because they're calculating inflation using formulas they can manipulate to their advantage. It's basically a bunch of propaganda. The bottom line is your money will be worth less tomorrow than it is today. It'll be worth less next year than it is today. It'll be worth even less in 2 years than it is today. Period. So you need to plan accordingly. This is why you need to save in real money. They can't devalue your gold and silver. They can try to manipulate the price, but they cannot devalue it. And you want to hold that real money because this is how fiat currency systems always work. So today's the day. Call Money Metals, 800-800-1865. Talk to a Money Metals precious metals specialist. Ask them your questions. They can help you. They can help you figure out how precious metals will fit into your investment strategy, what products might be best for you, the difference between gold and silver, ETFs, gold stocks, all of these things. If you have questions, these folks are available and they're happy to answer them. I know a lot of times folks don't like to talk on the phone. You don't have to. You can go to moneymetals.com. You can chat with the precious metals specialist online. And of course, these folks can take your orders for you. But if you know what you want, you want to pick up some of those Krugerrands, you can just click on the buttons, pick your quantity, pay online, and we'll ship that metal right to your home. Or if you want, you can store your metal in our state-of-the-art bullion facility in beautiful Eagle, Idaho. But regardless, do it today, right? They're devaluing your money today. You need to take action to protect your wealth today. So that is a wrap for this episode of the Money Metals Midweek Memo. You can get more information about all of the things that I've talked about on the show today and a lot more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your inbox, make sure you sign up. Get yourself on our email list. Of course, you can subscribe to the Midweek Memo on your favorite podcasting platform. And when you do, you'll also be able to tune into our Market Wrap podcast, which drops every Friday. You're going to get a quick overview of the week in precious metals, along with conversations between yours truly and interesting people from the world of gold, silver, economics, and investing. This week, I'm going to be talking to one of the folks over at the World Platinum Investment Council. So we'll be talking a little platinum and palladium. So you can check that out. But do all of that today. Thank you so much for listening to the show. I hope you have a fantastic rest of your week. And of course, I will be back behind this microphone again next Wednesday.